Hi, and welcome to Macro Wednesday. We talk macro and try to make sense of markets that, well, hey, how can they make sense? Bond prices were down. There's a rule about that. I'm your host, Steven Van Metre, and is the kingdom under siege? I've kind of wanted to say a sensational title like that, but today we're going to talk about the tactical breakdown in bonds and what it means to the kingdom of bonds. But don't worry, my loyal subjects, the crown is here, and yes, we're going to put that on because, the kingdom of bonds is always under siege. Nobody likes the kingdom of bonds. They just like throwing rocks at it. In fact, if I could throw rocks at myself or have flames to, talk about how the kingdom is under siege today, I would have done that, but I didn't have time. So what's going on? Because, see, everybody at some point will run to the kingdom of bonds. They will. Because when the big bear comes and ravages all the other kingdoms of risk, they will come to us. But don't worry. Do not worry. I've been working on a secret exit, and we'll head out the back, and then we'll take over their kingdoms, which will be there to defend them. And that's the whole idea of how this plays out. But what do I mean by a tactical breakdown in bonds? Well, let's go right to the chart, because I want to show you why technical analysis doesn't always trump fundamental analysis. And I've been meaning to get to some things about my thesis, and today's a really good way to communicate to you something that perhaps I haven't done a good job of. So let's look at what happened in the markets. Now, I've been looking at this potential pattern, trying to make sense of what it is, and it looks like it's a triangle pattern. Now, we know triangle patterns are consolidation patterns in the technical analysis world. And some of you say, well, that's just a bunch of hocus pocus. And look, I get it. Here's the way you should view it. You have sellers up here, buyers down here. And the sellers are slowly selling here. I'll go this way, selling less or at lower levels, and buyers are buying at higher levels. And you get to this endpoint where the triangle kind of starts to meet, and either you're going to get a move higher or lower. Now, of course, because it's bonds, I was very excited about this. In fact, I mentioned to big fan and friend of the show, Chris Dark, that something interesting was about to happen, except not in the direction that I thought. I was hoping this would be the catapult higher, and it turned out in overnight trading, which I'm always suspicious of because the overnight futures market is very thinly traded. We got a slam down in bonds, and then what happened? Just aggressive selling, boom, 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 all during the morning. It forms a bottoming pattern, briefly climbs back up into here, and then tails off before it gets back some of it at the end of the day. Why do we see this as a technical breakdown? Because chartists, technical analysis, and people look at this and saying the sellers up here won. And the buyers ran out. The buyers are done. And so now sellers are thinking, this is it, finally. And they come in mass now and throw everything they've got to try to drive this down. And there was quite a bit of volume, and notably somewhat of a reversal off the day's lows. Now that is exactly what a technical breakdown is. But like I said, I haven't done a very good job of communicating, my broad thesis, because I look at the show as kind of a running soap opera of, what my thesis is. I mean, we just continue to build upon it and expand upon it. And many of you ask, would you ever do a show, or can you point me to the show where you go through the whole thing? And I haven't done it, and I really have actually been meaning to do that. And I assure you that I will endeavor to do that at some point soon. Now, on Twitter today, there was a conversation that spurred because of this technical breakdown in bonds about, Steve, how do you reconcile tactical analysis, which is effectively charting and identifying where those buyers and sellers are at, versus your fundamental view or fundamental analysis? And my answer was, look, tactical analysis tells me short-term moves, but my fundamental view hasn't changed. My thesis hasn't changed. So, investors and speculators can move the markets around, a little bit here and there, but they can't change the underlying system. And, over the months and whatnot of all of this, I've always looked at this channel as kind of a community. And I do read all the comments, the ones, the supportive ones and negative ones, and the hateful ones. Unfortunately, I don't see a need for that. But it's even the negative ones I read, I try to respond to, and I do look at your review because like I said, I've always felt that as a community between the YouTube show, Twitter, the emails, that perhaps you're going to find something that I missed, and that's cool. And so there's a lot of this we can use to become better, because I don't know everything. I don't. I wish I did. But I've always said in the lead of the show, or not always, because I don't always say it, is to become better investors. 2 words, or plural. Sorry about that. If we can become better investors, it's you and I together, all of us as a team. So, when I look at what's going on today in the markets, it's really tells me that people don't understand the underlying fabric of my thesis. Because, over the time we've heard bond prices are only where they're at because the Fed's doing QE. Not exactly. Or, China's doing something, so that helps you out. Not exactly. That doesn't matter. Well, the pandemic really did. Look, all that stuff doesn't matter. Well, corporations are buying bonds, and if they didn't, it doesn't. Look, in the end, actually, none of that matters. Any of it is a bonus. Because people don't understand. And I want to share with you how this works. So, see, the monetary system is a living, breathing organism that adjusts to the conditions. It's very malleable. It's very flexible. And so it tries to adjust to what we've thrown at it. Now, the Fed looks at the monetary system and says, they just see a rigid box, and they say, no, we need to come in and we need to, move the monetary system around and change things. No, it's self-adjusting, it's self-regulating, and the Fed just monkeys with it, and people don't understand that. Because in a debt-based system, what makes your asset prices worth more? Right? What makes them, worth more? It's the expansion of currency, right? Think about, look, if you don't believe me, what if I could just wave a magic, well, kings don't have wands, so it won't work there. But let's say I could make all the currency in the land disappear. What would your house be worth? What would your car be worth? Your business worth? It'd be worth 0. What would your bank account? It'd be 0. Everything's zeroed out. If there's no money, nothing has any value other than what you could now then trade for it. So in a debt-based economy, the expansion of currency supports asset prices. Now, inside that, what many people understand is we choose as consumers or businesses where to direct that money. So why are, say, homes in Los Angeles, San Francisco, Chicago, New York more expensive than, say, Graham, Texas? Because people want to live in those places versus not many people, say, wanting to live out in Graham. We choose where money flows. Maybe it's because of weather or job opportunities or who knows, whatever reasons, we choose that. So we move the monetary system around to fit our needs. And in certain areas, things are more expensive than others. That's part of how it works. But there's one thing that people don't get. And if there's one thing you walk away from today's show and understanding this is what it is. You cannot have a move higher in interest rates, right? So interest rates cannot just go up because everybody wants to sell bonds and hurl rocks at the kingdom of bonds and shoot arrows and whatever things that people do to siege kingdoms, because investors and speculators want it. The monetary system adapts to that. It says, wait a minute, there's one thing I need in order for interest rates to go up. I need lending growth. If credit doesn't expand, you can't get a higher interest rate. Look, you can't have higher interest rates without an expansion of credit. It's just not possible. And you've heard me say that lower interest rates are tightening financial conditions. Well, now I'm going to throw you a wrench, and I can just hear the comments going like, what? Higher interest rates also tighten financial conditions. Anything that leads to lower lending growth or a further contraction in lending tightens financial conditions. Period. So the market's like, oh, we're going to drive interest rates up because there's a technical breakdown. Ha, 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 we're going to win. And it's the monetary system saying, nope. You can only get so far with it because what do we know from the Friday H.8 data? On a rolling 90-day basis, What is occurring in all loans and leases? A contraction. And so when you have a contraction in debt, what is it telling you? Currency is being destroyed. That's what it means. You cannot have higher interest rates when currency is being destroyed. You can push them up, but all it will lead to is a further destruction in currency as lending demand falls. And as lending demand falls, what happens? You get lower rates. So what will the monetary system try to do? What is it going to do as people continually short the bond market and try to push yields up? It will eventually contract asset prices down to a level where it can support these current interest rates. And in the process of doing it, it will lead to lower interest rates. So every move higher in rates that the market tries to force upon the system will eventually lead to lower interest rates. See, the key of my whole thesis is the monetary system, not just the laws governing the Federal Reserve, not just QE, not just the commercial banks buying bonds, not, the Eurodollar system or global trade. Look, the key is the monetary system says, look, I need an expansion of currency and I need lending and credit to grow to support all of these asset prices that you, as members of the monetary system, want. If you're not going to give that to me, I will contract asset prices down, and that's what happens in recessions. We have a dollar shortage that leads to a contraction of asset prices and ultimately lower interest rates. So when I look at today and I look at this chart and I say, is this really bad? Does this tell me that my whole thesis is shot and blown? No, it doesn't tell me that at all. It just tells me in the short term, sellers have won out. It doesn't mean that all of a sudden we're going to see a big explosion in interest rates. We're not going to go here and say, wow, that must mean that now the 30-year is going to head up to, 6% or, well, I can't even find a chart that, up to say 3.5% now because of a technical breakdown. No, the fundamental view has not changed. That is why that weekly H.8 data is so critical, because short-term move higher in interest rates like this will eventually get rejected by a lack of lending growth. Think of it simple. Sometimes if that doesn't make sense to you, think of this. You're a bank, right? So you are a bank, and I come in and I say, okay, here's $10 million. Go out there and lend it. And you go like, okay, great, sales team, we're going to go lend some money. Okay, get on the phone, call the best customers, call your worst customers. We've got $10 million to lend, and we'll say it's on cars. And you, as running the bank, I being the investor in the bank, you say, hey, Steve, don't worry, I'm going to get you 10%. We're going to get 10% on that money. And you get your whole sales team out calling, and you're going out to dealerships, man, we got 10% money. And you come back and there are 0 offers, 0. Not one application comes in that says, I want to buy a car and finance it through you. What does that tell you about interest rates? Yeah, it tells you they're too high. And what are you going to do? Well, we'll try 9%, 8%. So you will keep lowering rates until what happens? You get lending growth, right? Until someone says, hey, I got an application for you. And then you'll keep lowering them until you get so you'll keep lowering them until the demand for loans either meets the 10 million that I've given you to lend out or exceeds it, so you can buffer down to the best potential customers. That's what people don't get. My whole view is grounded by the monetary system, and it's a very powerful machine. The Fed doesn't understand it. Investors don't understand it. In fact, most people don't understand it. But you do. So let's take a look at the data, the economic data. And for those of you who have been asking for silver in the Sunday video, I'm going to put it in there just for you. Because I listen. I do. I read the comments. I listen to what you ask for. I can't give you everything, but I do my best. As you know, I want you to be here. I want you to learn. I want to see the show growing. And some of you even complained about too many commercials, and I did not realize that there was some forced, you couldn't skip ads, so I've turned off the forced watch on the ads, and so hopefully your experience here will be a whole lot better. Let's go back to Wednesday, and what do we see? Industrial production, preliminary out of August in Japan. slowed to 1.7%, still up but slowing. Retail sales in Japan still negative but slightly better at minus 1.9% on a year-over-year basis. So things in Japan aren't that great, although there's some data down here that suggests that there may be a turn coming. China's factory data shows still, slightish expansion, although you always have to take the Chinese data with a grain of salt. Coming down to some more Japan data on Wednesday, housing starts minus 9.1% on a year-over-year, so still housing in trouble. But construction orders in Japan shot up 28.5% on a year-over-year basis. So I don't know what's going on there, but all the other data in Japan looks pretty bad. But whatever construction orders have shot higher. Let's move on into the Eurozone. In Germany, import price index on a year-over-year basis is minus 4%. So what that means, in August, the German economy imported deflation. Retail sales in Germany up 3.5% on a year-over-year basis, although down from 5% the month before. How about in France? We're seeing disinflation. A preliminary CPI went from 0.2 to 0.1. Let's move on to... How about Italy? We see Italy CPI on a preliminary year-over-year basis flat at minus 0.5%. That obviously being deflationary. Moving into the U.S., we have mortgage applications down 4.8%. You can't read too much into this because it's super volatile, but there will be a point where people that were going to refi have refied, and this number should drop because interest rates are pretty low. I mean, even if they dropped, there's still not a big reason for people to refi lower. ADP reported a better than expected non-farm payroll report in September. Official one comes out on Friday. Change was plus 749,000, and I believe there was a revision the month before. I'm not worried about GDP. Second quarter came in at minus 31.4, largely matching expectations. And then what we've got here is this was the big news of the day. Chicago PMI factory data shows jumped from almost marginally expanding, barely, almost pretty much flat at 51.2 to wow, and a big move into expansionary territory. So this isn't a slight expansion, it's 62.4. This is a solid expansion. But as we dig into the Chicago data, we can go back and say, well, that was definitely an improvement because coming out in July, from June, it was the contraction stopped. In July, it was no improvement. August, no improvement. So really this 62.4 is saying we're starting to come off the bottom. Market interpreted as a boom in the Chicagoland factory area. Not quite how you do it. Pending home sales up 8.8%. People are definitely on the move, but what are we seeing in the real estate lending data? No growth, pretty much flat on a rolling 90-day basis. And then crude oil inventories fell, I think for now a few weeks in a row. And the market, of course, is bullish on oil, but on the charts, it's really not moving much. So kind of interesting. My inside connections in the oil industry say way too much glut. Don't worry about what you're seeing there. And with that, we'll be back on Friday to look at the lending data, which is super important. Be sure to like and subscribe to the Kingdom of Bonds. We're always happy to have you. And now you know a whole lot more about my thesis and why sometimes it appears that perhaps my confidence, which some of you think is arrogance, really is just my understanding of how the monetary and system and interest rates work together. I'm Steve Van Metre. Thanks for watching. We'll see you on Friday. Bye now. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. It is not to be construed as a recommendation or solicitation by selling security, eventually against or participating in a particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.